Devon Energy has just made a bold $5 billion move, fueling debate over whether its debt-laden expansion is visionary or perilous. With net earnings down but production at record highs, is this strategic gamble set to pay off? We're diving deep into Devon's financials, operational efficiencies, and market position to uncover the truth. Ready? Let's go. Devon Energy, a major U.S. oil and gas producer since 1971, operates over 5,000 wells. With a market cap exceeding $21 billion, it has significant industry presence. Its beta of 2.07 indicates higher stock volatility than the market average. Devon Energy's balance sheet shows significant changes as of September 30th, 2024. Cash and equivalents decreased to $676 million from $1.169 billion last quarter, mainly due to the $5 billion acquisition of Grayson Mill. This strategic move, funded with $3.5 billion in cash and shares, aims to boost production capacity. However, total debt rose to $9.212 billion, leading to a negative net cash position of $8.536 billion. The debt-to-equity ratio increased to 0.636, indicating higher financial leverage, meaning more debt relative to equity. While this raises financial risk, management believes expanding operational scale will enhance shareholder value. Despite the increased debt, Devon maintains robust liquidity with $3.7 billion available for operations and shareholder returns. Here's a screenshot of the full balance sheet. Devon Energy's total assets rose to $30.3 billion, indicating growth. Notably, goodwill increased to $1.8 billion, which could suggest intangible value from recent acquisitions, but it warrants careful assessment of future profitability. Devon Energy's solid capital structure is highlighted by negligible preferred stock and high retained earnings to market cap, surpassing most industry peers. Favorable debt to equity further strengthens its position. However, low cash minus debt indicates potential liquidity concerns compared to the industry. Devon Energy's net earnings for the 9 months ended September 30th, 2024, decreased to $2.3 billion from $2.6 billion a year earlier, mainly due to a $331 million drop in realized prices from lower natural gas and NGL prices. Increased production added $367 million in revenue thanks to new wells in key areas. Gross margin slipped to 27.57% and operating margin to 24.33%. Notably, the SG&A margin remained exceptionally low at 0.03%, showing strong control over administrative costs. Management expects increased production to bolster revenues ahead, potentially improving margins. As value investors, we should monitor if these efficiencies translate into sustained earnings growth. Here's a screenshot of the full income statement. Notably, depreciation costs increased, highlighting the capital-intensive nature of the energy sector. However, Devon's ability to maintain low financing costs underscores potential for leveraging growth opportunities efficiently, a crucial factor for sustaining long-term value creation. Devon Energy demonstrates exceptional efficiency with its SG&A margin, outperforming 98.9% of industry peers. However, its EPS growth lags, surpassing only 38.6% in the industry. Profitability margins are solid, ranking above industry median and even stronger against the S&P 500. Devon Energy's revenue has fluctuated over the past year, peaking at $3.84 billion in Q2 2024, before settling at $3.74 billion in Q3, reflecting changes in commodity prices. Net income declined to $812 million in Q3, impacted by a $331 million decrease in commodity prices, which reduced profitability. Notably, operating income, a measure of profit from core business activities, remained stable around $1 billion, indicating effective cost control. This stability suggests resilience in operations, despite market volatility. Looking forward, increased production from recent acquisitions is expected to boost revenues, supporting management's strategy to optimize operations and capitalize on market opportunities. In Q3 2024, Devon Energy reported a negative free cash flow of $2.816 billion, primarily due to substantial capital expenditures for the Grayson Mill acquisition. Free cash flow is crucial as it reflects the cash available after capital investments, impacting a company's ability to fund operations and return value to shareholders. The significant capex, consuming over half of the operating cash flow, may strain short-term liquidity. However, strategic acquisitions like this can drive future growth. Consistent stock-based compensation of $24 million underscores a commitment to retaining key talent. Despite the cash flow dip, robust liquidity suggests confidence in sustaining operations and maintaining dividends and buybacks. Here's a screenshot of the full cash flow statement. Notably, operating cash flow remains solid, covering most of the capital expenditures. Though acquisitions strained liquidity, maintaining disciplined financing through minimal debt raises signals of prudent strategy. This approach supports stability and potential long-term value, despite current challenges. Devon Energy's CapEx margin ranks at the bottom of both industry and index, indicating inefficiency in capital spending. With free cash flow yield also significantly below peers, cash generation is weak. While stock-based compensation is moderate, overall cash flow metrics raise concerns about operational efficiency. Analysts forecast steady growth for Devon Energy, with net income projected to rise from $3.4 billion in 2024 to $3.42 billion by 2028, and EPS increasing from $4.69 to $5.33 over the same period. This suggests modest earnings improvement, supported by the company's focus on operational efficiency and the Grayson Mill acquisition. However, given the volatility in commodity prices and geopolitical risks, it's important to consider how these factors might affect future profitability. Effective risk management will be crucial for Devon to meet these targets. Devon Energy surpassed production expectations in Q3 2024, hitting a record 7,280,000 barrels of oil equivalent per day, and raised its annual guidance by 12%. They generated $786 million in free cash flow. The cash a company generates after accounting for capital expenditures, returning over half to shareholders via buybacks and dividends. The Grayson Mill acquisition is enhancing operations, tripling production in the Williston Basin. Management remains confident despite market volatility, focusing on disciplined capital allocation to maximize returns while keeping debt low. They project continued growth in 2025 with higher production forecasts. Notably, they didn't declare a variable dividend, prioritizing debt reduction and share repurchases. Devon's strong operations and prudent management indicate potential value for investors. Devon Energy's lower BOE scores in net income and EPS, trailing most industry peers and S&P 500 companies, raise concerns about its profitability efficiency. This underperformance might suggest operational challenges affecting earnings, which is crucial for investors seeking value. Devon Energy's PE ratio of 7.73 is notably lower than many peers, indicating potential undervaluation. For example, Coterra Energy's PE is 11.87, and EOG Resources stands at 9.25. A lower PE suggests the stock may be cheaper relative to its earnings. Devon's PB ratio is 2.40 reasonable, but higher than competitors like Coterra's 1.48. Management is cautious about price volatility, focusing on maintaining shareholder value. Strategic initiatives such as recent acquisitions to enhance production aim to improve future performance metrics. The success of these strategies, along with effective capital allocation, will be crucial as Devon navigates a competitive landscape to enhance its valuation against peers. Devon Energy's PE ratio outperforms most of the S&P 500 and surpasses over half of its industry peers, indicating strong earnings value. However, its PB ratio is weaker compared to industry competitors, suggesting its stock may be priced higher relative to its book value. Our discounted cash flow analysis projects Devon Energy's 2024 revenue at $19.44 billion, with free cash flow of $2.52 billion, suggesting an equity value per share of about $68.23. These optimistic figures arise from expected efficiency gains and increased production after the acquisition. However, because the company relies heavily on oil and gas prices, there's significant risk from commodity price volatility that could negatively affect these forecasts. Considering various growth scenarios can help manage these uncertainties and align operational goals with shareholder expectations. Devon Energy's DCF score surpasses 75% of its industry peers and nearly 89% of the S&P 500, indicating a strong valuation relative to both its industry and the broader market. This suggests potential undervaluation and an attractive opportunity for value investors. Despite a recent stock price dip, analysts forecast an upside for Devon Energy, averaging $50.50 per share. Investments like acquiring Grayson Mill increase production capacity which could boost valuations if commodity prices rebound, key for oil and gas companies' profitability. Devon Energy's analyst target score outperforms 71% of its industry and 97% of the S&P 500, indicating strong market confidence and significant anticipated growth relative to both peers and the broader market. Devon Energy's bold acquisition of Grayson Mill represents a calculated move to amplify production and drive future growth. The resulting increase in debt elevates financial leverage, introducing heightened risk. However, the company's robust liquidity position and exceptional cost controls, evident in its industry-leading low SG&A margin, underscore operational strength. With a low PE ratio signaling potential undervaluation, there may be an attractive opportunity for value investors. The key lies in how effectively Devon can translate this expansion into sustained earnings growth amidst commodity price volatility. Monitoring debt management and cash flow generation will be crucial to determine if this strategy enhances long-term shareholder value. Make sure to watch another video from our Value Explorer series by clicking the playlist below.